Hey folks, welcome back to the channel, and today we are going to talk about the VIX index. It's a tool to measure the expected volatility of the stock market, and the movement of the VIX is often negatively correlated with the price movement in stocks. In other words, the lower the VIX is, the higher the stock market tends to be. A lot of investors have used the VIX to help gauge when to enter the markets, and in certain cases, it can be a pretty reliable indicator. For example, on Twitter, Charlie put out this research he did where you buy and sell the S&P 500 based on the VIX, and he discovered that throughout this year you could have made a lot of money if you followed this one rule, which is buy the S&P 500 when the VIX closes over 30, because 30 is considered higher than average for the VIX, and when the VIX is high, stock markets tend to be low. And then you want to sell the S&P 500 whenever the VIX closes below 20. So you're basically buying on weakness and selling on strength. And if you had done that throughout this year, you would have been up 27.9%, represented by this blue line here. This dark line is if you had just held the S&P 500 from the beginning of the year, you would have been down 14% as of this tweet, which was from a few days ago. Now this red line down here, this minus 33%, is if you had done the opposite of the first strategy, right? So instead of buying the S&P when the VIX goes over 30, you would buy the S&P when the VIX closes below 20. So basically the opposite. And then you would be down 33%. What this means is so far this year, if you had bought the stock market when the VIX was high, and then you sold when the VIX closed below 20, in other words, you took profits, then you would have made a nearly 28% gain. So why is this important right now? Well, it's because if we look at the VIX, this is looking at the daily chart, and we have come down a long way over the last couple of months, and the VIX is sitting now at 20.5. So we're very close to that target that Charlie was talking about in his tweet. So looking at TradingView here, for the VIX, this purple line here is 20, and then this upper purple line is 30. So the last couple times when the VIX dropped below 20, which is over here in April and over here in August, let's take a look at what the S&P 500 did. This is the S&P 500 index in April, where the VIX went down below 20. You can see there's a peak for the stock market, and also in August there was another peak. And right now, as the VIX is getting closer to this 20 line again, what does it look like for the S&P 500? Well, it's getting very close to this top of this channel. So if I go to a weekly chart, you can see that the stock market pretty much follows this downward channel so far, and we've hit the top 3 times, and it looks like we're about to hit it again as soon as next week. If I go to a monthly chart, basically throughout this year, even in November, October last year, all of these candles, each candle represents 1 month. All of these candles have been inside of this downward sloping channel, this basically yellow channel I have here. So the chances of the stock market continuing to be in this channel for next month in December is fairly high given this pattern that we're seeing. Now we could break out of this channel, but I think the chances of that is pretty small. So most likely in December, we're going to see a red month. Now if I go back to the daily chart, I think one thing to keep in mind for the next couple of weeks is to really just understand what this resistance line means. So first of all, we have the VIX telling us that there is a high potential that we are going to see another stock market reversal, because throughout the last couple of months when the VIX was dropping down like this was from like mid-October, the stock market, the S&P 500, was going up. But if the VIX were to reverse and go up, then it would make sense for the stock market to go down. And judging by this channel, that is most likely what is going to happen. So what I'm watching for next week is to see what the S&P 500 does. If it hard rejects off of the top of this channel, then I'm going to be pretty bearish, at least in the medium term, like over the next month or so, because chances are we're going to fall lower. And also, if we take a look at this blue line here, this is the 21-day exponential moving average. Right now, we are extended from this line, and historically speaking, whenever we have the stock market extend too far away from this EMA, it drops down. So like right now we're kind of extended, so we're probably going to see a drop pretty soon, like over the next couple of days, if not maybe next week sometime. So that's another reason for the stock market to go down. And then something else to watch out for is if I turn this 21 EMA into a 200-day EMA, you can see what happened the last time the stock market touched the 200-day EMA. Basically, there was a hard rejection, and it also just coincided with the top of this channel. And so right now, the 200-day EMA is right here. here. So at the start of this coming week, not only does the stock market has this blue line 200-day EMA resistance to worry about, but if it gets past that, then it has this bear channel, which we've been in over the last year now, to also try to get past. So I think we're either going to chop around here if the market is feeling bullish, or we're just going to straight up get rejected and start heading lower. So there's definitely a lot of reasons why the stock market should be quite bearish over the next couple of weeks. Now, I'm not saying anybody should go out and buy put options, and definitely don't short the market. But what I am saying is be careful if you're thinking about putting a large chunk of money into the market over the next week, because there is a high chance that right now is probably not a very good time to do that, just based on the VIX, based on technical patterns. And if we look at the CNN's Fear and Greed Index right now, it's at 64, which is quite greedy. So if you are going to dollar cost average, buy a little bit. And then what you should be looking for is, first of all, look at the VIX over the next week. See if it drops below 20. If it does, then that could be a sign that we are going to get another one of these large sell-offs like we've seen in the past. And usually they're pretty steep, like it's this kind of angle, so that by next year, around the end of January or beginning of February, the S&P 500 could be at around 3,200. It's at 4,000 today, so that's a 20% drop from today. And it's very possible that it could get there, especially when, there is some support here at 3,200. A lot of economists are saying that the stock market is dropping to 3,200. Although I do think 2023, the stock market is most likely going to be up for the year, so it's going to be a better year than this year. I'm less certain about how it's going to get there. So we could see at the beginning of the year kind of this dip into January, February, before we see the final climb back up into maybe not new highs, but at least back to the 4,000s or mid 4,000 range. It's really going to depend on how fast inflation comes down and where interest rates go. But for the time being, I think it's worthwhile to just notice what's happening with the stock market. So the bear market may not be over, especially when you look at the assets on the Fed's balance sheet. Looking at the Fed website here, the Federal Reserve is still dumping assets. You can see this line coming down, and every time it comes down, it means they are reducing liquidity in the financial markets. And part of the reason from, say, 2000 to 2001, the stock market went up so much is because they added all of this liquidity into the market. But ever since like around April or May of this year, they started to sell assets. So that's one reason why the stock market has fallen so much over the last 6 or 7 months. So what does this mean? Well, next week is going to be really important, right? Because if the stock market goes over, then what that means is we've broken out of this channel, which we haven't done in like over a year. It would be like the first time. So that would be pretty big. And what it could mean is that this right here was the low of the market. In other words, we would have started a new bull market back then in October. So at that time, I would be more bullish, but I would have to wait for at least a full weekly bar above this channel in order to get confirmation that we're no longer in the channel. So that's one scenario, but I think a more likely scenario is we're going to come up, hit this line, and come down. Either we're going to come down to the middle of this channel and bounce back up, or the bottom of the channel in like one of the worst case scenarios. So because of that, I am waiting. I am not going to buy any new stocks over the next couple of weeks. I'm also not going to sell any stocks. I'm waiting for confirmation of whether we're going to exceed past this channel or we're going to stay within this channel and most likely go down. And if the latter happens and I start to see a couple weeks like here going down, a couple weeks of red like over here as well, then I'm going to be bearish. I'm going to not really short the market, but maybe I will sell covered calls. Maybe I'll even buy a few puts. I'm not going to touch the majority of my portfolio, but I will be using options to try to catch this next trend, whether it be upwards or downwards, mostly selling out of the money options. So that's just a heads up for anybody looking to buy stocks this week or the next week, is just keep in mind that we are coming up to that point. So just be careful, because there's nothing wrong with just sitting on the sidelines for a while, especially when the VIX is sitting so low around 20 and the S&P 500 is near the top of a bear channel and the Federal Reserve has not stopped increasing interest rates. Now they may increase it by a smaller amount, but unless they start to cut rates or unless their balance sheet starts to not even go up but maybe just stay flat, then any bullish movement in the S&P 500 will likely be short-lived, because in order to get a sustained rally and for us to go over 4,500 or maybe even 4,600 back up to near all-time highs, we need to see a real pivot from the Fed, like actually cutting rates or doing more quantitative easing. So that's just a word of caution for me. Do your own research, of course. Good luck with your investments, and let's see where the S&P 500 goes from here. I'll probably make a follow-up video once we get confirmation of where the market may be heading over the next few weeks. So thanks a lot for watching, and I'll talk to you in the next one.